Hello and welcome to Moneylife. This is Sucheta Dalal. This week we are going to talk about the safety of your deposits. In a sense, the government is offering you a carrot and a stick policy. So on 15 November, Finance Minister Nirmala Sitharaman announced that your bank deposits, which so far are insured only up to 1 lakh per depositor, is going to be increased to 15 lakhs, or rather may be increased to 15 lakhs. What she doesn't say, but which has been making news in various newspapers, is that a controversial bill, which is called the Financial Resolution and Deposit Insurance Bill, which was introduced earlier and withdrawn, is going to make a comeback in a different avatar. Now, last time in 2017, this bill was introduced in the Lok Sabha without any discussion. It triggered enormous panic. People began to withdraw their money even from public sector banks because remember, every day there were news reports about how the bad loans of banks had been increasing, and in fact they now stand at 10 lakh crore. So there was understandable panic. People thought that they have to be careful about private banks and that there was an implicit sovereign guarantee when it comes to public sector banks. But there was a controversial clause called the bail-in, where it was said that a part of depositors' money would be converted into equity and used to recapitalize banks. This created panic. There was such a furor that the government quietly withdrew the bill in August 2018. So now, when you've had again multiple failures, you've had the collapse of several organizations, the most important being Punjab and Maharashtra Cooperative Bank, where 9 people have lost their lives. The government feels the need to do something to appease depositors. And there's a demand from people. Lots of people, without thinking, seem to think that insure the deposits. Some have even gone as far as saying insure 100% of the deposits. What people don't seem to understand is that any insurance comes with a price. It's like your health insurance. If you want a big fat health insurance guarantee, you pay a big fat premium every month. So if you want 100% of your deposits guaranteed, it makes no business sense and it will come at a price. So when the government says that they're going to insure 15 lakhs per depositor, before you start celebrating or making plans to divide up all your savings into multiple bank accounts and keeping just 15 lakhs in each, think about the overall price that this is going to have. The reason for me to even do this video blog and have a discussion is because the government's propaganda machine is already at work through mainstream media, and they're going to run down every one of us who has raised doubts, asked pertinent questions, and won answers before a major sweeping decision like this is taken. So what do you have? You have a mainstream newspaper saying that while the government tried to ram the bill through the Lok Sabha in 2018 without a discussion, we are told that it was withdrawn because of ill-informed social media chatter, misinformation, and a misplaced campaign that depositors' money would be used to bail out failed banks. It is used to bail out failed banks. As I've said in a previous video blog, even in Punjab and Maharashtra Cooperative Bank, when the Reserve Bank of India steps in and says you cannot withdraw your own money, your own hard-earned tax-paid money, which is kept over there, even if they generously give you 50,000 of your own money back, the rest of it is confiscated in a sort of bail-in. And the salaries that are being paid to these bank employees is coming from depositors' money. Yes, it's not yet been converted into equity, but India already has a system of eating it up. So there's nothing ill-informed about this chatter. It is the voice of experience because one cooperative bank fails every month. We are lucky it hasn't happened with others. So let's not fool ourselves. Now, let's look at what happened with this withdrawal of the bill. So if it was ill-informed, think about what has happened post the bill. Did we have reason to worry in 2018 August? Let's narrate a few things that happened after August. Just 1 month later, after the bill was withdrawn, you had this massive collapse of infrastructure leasing and financial services. It had an outstanding debt of 1 lakh crore, and while the core company wasn't listed, many subsidiaries were. They had hundreds of step-down companies, 347 to be precise, RBI was caught napping. It's another example of failed supervision. The RBI arrogantly refused to listen to any whistleblower, including institutional ones. So it's not just IL&FS with nearly 1 lakh crore outstanding, which created huge systemic issue in the financial system, but that triggered a whole lot of other issues. So soon after, Moneylife, at least in December 2018, our editor Devashish Basu wrote about Diwan Housing and Finance. After that, there was a Cobra posting operation, and it has taken an entire year. It is only 2 days ago that the RBI has finally sacked the board of this controversial company. The outstanding of Diwan Housing is much more. People are likely to lose money in fixed deposits, in non-convertible debentures, and then, of course, there is the massive lending by public sector banks. In fact, public sector banks have had a big role to play in the kind of reckless lending that's been going on since 2008, which has led to a huge jump in our bad loans. Now, the mainstream media, of course, says that the answer to all this is to have the FDRI bill. Already told you what it is: financial resolution and deposit insurance. The carrot of deposit insurance, throwing 15 lakhs at you as assurance and bringing in a resolution corporation. None of us is opposed to resolution. You need to have a systematic resolution plan. This has to work well because, as we know, IL&FS, the board was sacked, and you have a new team trying to sell things, but not a single rupee has been recovered, because unless you have a resolution system, all of it is going to be locked up in court cases. So by all means, create a resolution corporation. But who says that's going to work any better? Because what mainstream media, especially the Economic Times, is touting as examples is what has happened with the Z Group, what has happened with Reliance, where mutual funds who had no business lending against shares to the promoters of these groups had done something that they should not, was against the rules. Not only did they lend to them, that money has been trapped, but they also kept quiet when these corporations fudged issues and did not disclose it to stock exchanges, so the public at large didn't know. It's only when those shares had to be sold and prices began to fall that the dirt was out in the open. Even today, SEBI has taken no action. Okay, so forget about resolution. SEBI has taken no action against the people who turned lenders instead of investors, which is mutual funds in a fiduciary position, and instead SEBI is tinkering with the rules. There's no point. We're tired of regulators tinkering with the rules after our money is lost. They need to be alert, they need to be accountable. And we want to know how a resolution corporation is going to make regulators accountable. So you want to bring in an FDRI bill, by all means do it, but fix the issue of regulatory accountability. Once you have the top regulators accountable, which is A, the Finance Ministry, B, SEBI, and the third is the RBI, they then need to be accountable for all the others that they're regulating, which is statutory auditors, which is rating agencies. Today you have a mess because every single of them, one of them, including trustees of mutual funds, have indulged in rampant dereliction of their fiduciary duty. And it is we, the people, the depositors, the investors, shareholders, who are paying the price. This cannot go on. We can't have a new bill foisted on us. Now I'm going to discuss the whole issue of deposit insurance and why you should not be celebrating 15 lakhs without understanding whether it's even viable. And this is another thing which we want the government to explain. Okay, so let's go back to basics. We used to have 1 lakh of deposit insurance per depositor. This happened in 92. Why 92? Because you had a massive security scam at that time. RBI was under pressure, again failed supervision, and so it covers it up, appeases us by saying we're raising deposit insurance from 30,000 to 1 lakh. Since then, it hasn't bothered, because the only failure in the last 25 years is cooperative banks. And believe me, there are 1,900 of them. They form the biggest chunk in numbers of our Indian banking system. While cooperative banks have failed at one a month, and I'm never tired of saying this and repeating it, we've had no failures in commercial banks, because you had some privatization. A few private banks have done exceedingly well. So every time you had newly licensed small banks doddering, they were quickly taken over. The one big, failure that we could have had was Global Trust Bank after the Ketan Parikh scam in 2000, 2001. There, the RBI had a forced merger with a PSU bank. I don't think a forced merger is a good idea because a good, well-run PSU bank was forced to take on, and it took another 7 or 8 years for it to swallow and merge and come out of the pressure that it faced when this takeover happened. So that is not a solution. We had another scare recently with Yes Bank. Fortunately, I think that is over the hump and things seem to be okay over there. Does this mean that deposit insurance is working well with commercial banks? I would urge you to think twice. Now, very interestingly, I've talked about this a little earlier, but the All India Bank Employees Association, which is the largest bank, PSU bank trade union, has raised this issue in a letter to the Finance Minister on 18th November. What has AIBA said? They have said keep PSU banks out of deposit insurance. Correctly, we have said this also. Why? Because there is an implicit government guarantee. They're owned by the government. They are PSU banks. They still account for 70% of our deposits. So why are you collecting money from them? Now, what the Deposit Insurance Guarantee Corporation, which handles this, is a 100% subsidiary of the Reserve Bank of India. What it does is that it collects insurance premium from every bank. Private banks, foreign banks, public sector banks, and cooperative banks were earlier not a part of it, but they were included. Again, if you ask me to appease politicians, remember cooperative banks are under dual regulation. That is why they fail. Because there's political interference, they're controlled by politicians, and the RBI is a part-time regulator and has not been doing its job. So these banks had no business being brought under deposit insurance at all. But they not only were brought, all the payments. So since deposit insurance was brought into the picture somewhere in 1960-61, the only payouts, literally the only payouts have been for failed cooperative banks. And again, this number is not much. It's just a little over 5,000 crore. While the premium collected is over 93,000 crore. This is the amount of premium that DICGC is sitting on. So what is the bank union saying? That take out PSU banks from the whole list. What happens? Okay, it makes 2 points. Okay. One is the manner in which, now when a regulator's 100% subsidiary is giving insurance, it does what it wants to and banks have to fall in line. So it is been collecting the premium for the entire deposits, which is 120 lakh crore. That is the number on which at 0.10% it has been collecting a premium. But if you calculate that its responsibility is only to pay up to 1 lakh per depositor, this is supposed to be hardly 30%. So the amount that DICGC ought to collect itself should have been significantly lower. So AIBA has said, why, first of all, why are you collecting on the entire deposits? And second, keep us out. If they do that, there is no way on earth that the Deposit Insurance Guarantee Corporation will have even the money to pay the 1 lakh that it has promised to cooperative banks. So you will have to get cooperative banks, 1,900 of them, out of the picture, right? If you do that, there have been several RBI committees. Now, thing about RBI is that every problem has been discussed endlessly over 30 years with a formal committee. What happens is that the committee report is buried and ignored. So various committees have said introduce a risk-based premium. If there is a risk-based premium and PSUs are not in the picture, if you ask me, it's going to be so high that cooperative banks will probably opt out of insurance. That's not such a bad thing. As long as it's well publicized, that will ensure that people like you and me are not fooled into thinking that cooperative banks are on par with regular scheduled commercial banks and that your money is just as safe over there. So if they can't afford the premium, that will be a good thing. They can move out of it. But we know that's not going to happen because they're all controlled by politicians. So where do we go from here? So, to understand the kind of breakup that you have between the premium paid, commercial banks, all of them together, pay 11,100 crore. That's in 2018-19. Cooperative banks paid only 85 crore. This is how little that they pay. And the total collection, I said earlier, was 93,000 crore. It is not, it's 97,350 crore. And the sum total of insurance payouts since 1962 is, like I said, only 5,120 crore. And this is not going to work because the whole structure of insurance has to be reworked. In fact, when I wrote about it a couple of weeks ago, a former chairman of a leading public sector bank wrote to me to say that if effective insurance risk stroke actuarial model is used to as a measure, then it will be very clear that the ICGC cannot manage the burden of insuring bank deposits of even 1 lakh. Okay, so now from 1 lakh you're going to move to 15. So what's going to happen when this 15 happens? At the moment, the GICGC rules are that banks have to pay you the premium. It can't be recovered from depositors. When it goes to 15, this Economic Times news report, which is obviously based on a discussion with the government, says that the money will come in the form of lower interest paid to depositors. Interest rates are already falling, they're below 6%. Many people, especially pensioners who don't have a government pension, live on interest rate that they earn. And this interest is, remember, taxable. So you pay a tax on it. It is already below 7%. Now, if you're going to get a 15 lakh insurance, I've already told you the problem in 1 lakh. That insurance premium is going to be collected from the interest that's paid, which means that even on fixed deposits, your interest will sink dramatically. And on savings account, where it is about 3.5 or less and falling, it's probably going to be negligible. So remember, if you think your money is safe, it is safe only because you're paying for it. And this is not a workable system according to me. It makes no sense to increase it to 15 lakhs. Under 15 lakhs, at 15 lakhs, they say 90% of deposits will be covered. But there is going to be a steep price. And instead, we have been arguing that that steep price cannot be collected from us. We need regulators to be accountable. If I keep my money in a bank, the bank earns a nice fat spread. 1 lakh is good enough, maybe double it to 2, but you can't have 15 lakhs, which is by picking our pockets, by giving us lower interest with the same unaccountable system. Will this be accompanied by better responsibility? Will some heads roll in SEBI and RBI? And when people lose their lives out of the shock of losing their deposits, are you satisfied with a few regulators losing their job? It's not good enough. There has to be a price. So far, nothing has happened. Whether it is a statutory auditor like Pricewaterhouse or a trustee, they have plenty of money. Catalyst trustee, in fact, in Diwan Housing is an example. They have all the money to go to court, keep dragging it through the appellate tribunal, the Supreme Court, various high courts, while your time is ticking, your life is oozing out, your savings have gone, there is zero regulatory accountability. So it is not rumor mongering, it is not spreading false information. We are seriously concerned as depositors about what the government is going to do about regulatory accountability, and when it wants to increase deposits to 15 lakhs, can it please give us the math? And don't fool us by saying that it will come from public sector banks, because we, the people, are paying a lot for public sector banks. Do you know that in the last 5 years, the exchequer, straight from the budget, has paid 3 lakh crore to recapitalize public sector banks? So they lend recklessly to a few hundred industrialists. The money comes from our pockets. What is tragic about this is even somebody who does not so much as have a bank account or probably doesn't have 2 square meals a day is actually paying for those bad loans because it's going straight from the budget. So there is a price. Stop fooling us on the structure of deposit insurance. Don't throw a carrot at us about 15 lakhs. Tell us what you're going to do about regulatory accountability, and tell us how you're going to move fast to get our money back, whether it's in Diwan Housing, whether it's in PMC Bank. So far, we have zero answers from the regulators. India is a strange country where not even your members of parliament manage to shake up the government enough to get a statement out of the RBI governor or the finance minister on what is the exact situation. They say they're looking into it, trust in us, and we will take our time. Is it good enough for you? I don't think it's good enough for me. Thank you so much.